Have you ever wondered if there are hidden fees slowly chipping away at your investment earnings, even when you are not actively trading? It is a crucial question that many investors overlook, but understanding these charges is vital for maximizing your financial growth. You pay investment transaction costs in various forms, including commissions, bid-ask spreads, and expense ratios. These costs are not always obvious, and they can significantly impact your long-term returns. The actual amount you pay varies widely, depending on the type of investment, the brokerage firm you use, and how often you trade. These costs exist because investment transactions involve services and market mechanisms. Commissions are direct fees paid to a broker for executing a trade, covering their operational costs and profit. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept for an asset. This spread represents a profit for market makers who facilitate trading by buying at the lower bid price and selling at the higher ask price. For mutual funds and exchange-traded funds, or ETFs, expense ratios cover the fund's management, administrative, and operational costs, essentially paying the professionals who manage the fund on your behalf. To better understand and manage these expenses, start by reviewing the fee schedule provided by your brokerage firm. Look closely at the prospectus or offering documents for any funds you are considering, as they will detail the expense ratios and other potential fees. Comparing different brokers and investment products can reveal significant differences in costs. Consider using passively managed index funds or ETFs, which typically have much lower expense ratios than actively managed funds because they do not rely on expensive portfolio managers making constant trading decisions. A key concept here is that even seemingly small fees can have a compounding effect over many years. For instance, a 1% annual fee on an investment portfolio can reduce its value by tens of thousands of dollars over 30 years compared to a portfolio with a 0.25% fee, assuming the same growth rate. Many financial advisors who operate under a fiduciary duty are legally obligated to recommend investments that are in your best interest, often guiding clients towards lower-cost options. This focus on the total cost of ownership for your investments is a hallmark of smart financial planning. Taking the time to research and minimize your investment transaction costs is one of the most effective ways to boost your overall returns without taking on additional risk. By understanding where and why these fees occur, and by actively choosing cost-efficient investment vehicles, you empower your money to work harder for you, securing a brighter financial future.